Hello and welcome to section 2 or lesson 2 of the trading spreadsheet for vertical option spreads, the 1.8 standard deviation inflection point. Now last time in lesson 1 we looked over the 4 sheets. Option 1, and I'll use the cursor as much as I can remember. It's interesting, the software screen capture shows the little yellow dot for you, but I can't see it when I'm filming, so bear with me if sometimes it winds up in the corner and you're wondering, why does he have it over there? Well, it's because I can't see it when I'm recording, so I'll try to keep that in mind and be patient. We also looked at option 2, so a quick review. Tab option 1 was the let me get it over there, is the long put. So this sheet does all the work for a long put, regardless of how much time we have to expiry. In fact, again, just refreshing memory, what the cell here does, the 5 days to expiry, right now it's set for 5 days, which is reference to this cell for, if you will, 50. Obviously, I've taken the 50, divided it by 10 over here so I could cut into increments of a day. And what that's doing is valuing the stock. So if I put in 300, which would be 30 days, what that's doing is taking, I beg your pardon, let me make this completely straight. It's not valuing the stock, it's valuing the option. So a 30-day option at a certain strike. So if the asset price was at, say, 170, a 30-day option at a 18% implied volatility, which is right here where I've got the cursor, should be running at about $1.37. So a 164.50 put would be running at $1. It's a way very much out of the money put. So if we wanted to look at, say, an at the money put at 18% implied volatility, it'd be about 349 with 30 days left to go. Now, what I did not explain to you in lesson 1, and we'll go ahead and say it now, is that the spreadsheet, if we're looking at an X amount of days of analysis, let's say 5 days to analysis, or if we bumped it up to 10 days, as an example, what's going to wind up happening is that you'll notice the option put stayed the same price. However, the 10 days is controlling the amount of the stock price movement. I repeat, the 10 days is what the timing is for the stock price movement. We're only analyzing 10 days out of a 30-day put. So if you plan to be in a trade for only 10 days, but you're going to use a 30-day out to expiry, in this case a put, well, this is the way you would set the sheet up. So as a quick example, and then I'll get on to other things. We're going to be covering all of this in each lesson. Some of the lessons are as structured as I can be, but there's so many different things we can do with these spreadsheets that I'm going to go through them as I'm thinking about them to a certain extent as well, so that you get a good full idea of how to use this spreadsheet. Let's go to tab option 4, way down here where I have the cursor. This is a long call. So let's say we're very, very optimistic about a particular asset. The asset's trading at 170, which of course is the price which was controlled from sheet option 1. So we say to ourselves, all right, let's go in with an at-the-money call. So a 170 call. At 18% implied volatility, it'll be very close to the put price. Little bit higher because of the fact, believe it or not, that the long call, even though the asset is at the money, the long call will generally have a slightly higher price than the long put because of the log normal distribution. There's more, it can never go lower than 0, but in theory it can go up to infinity. So the long call, it's going to be very close. You might be wondering, well, how come on option 1, we'll go back to the sheet, This is priced at 18% implied volatility at 349, and the call's at 356. Well, with the Black-Scholes model and using the log normal distribution, what's happening is that there's actually a better chance that the call will slightly, very slightly, perhaps 50.1 or 50.2% to 49.8%. The call will actually wind up being more valuable at expiry than the put. So that's why there's a slight discrepancy in the pricing, in this case, 7 cents. All right, here's the deal. On this example, what we're trying to do is to say, all right, we're going to go long one call for 356. The asset's at 170. We're going to use a strike price of 170. We've got the historic volatility set up at 10.4%. The annual return we're guessing at 0. And the implied volatility at 18. Fine. That's just what we set up in tab option 1. That's where we can set up all of these parameters that are going to fit along the whole analysis. Now, if we go to the net sheet, which is the next sheet we'll study in detail in this course, what I'd like you to do is let's go ahead and turn off the switch for the long put, the short put, and the short call. So all we're really looking at is one long call. And in order to do that, I've got to come over to here. Okay, it's a little hard to see with all this stuff colored yellow, but you'll notice here I've got the quantity set at 100. Well, we're only going to be trading one, so I'm going to change these cells to one apiece, and that's going to look a lot more realistic for us. So now when we go back to the net sheet, what we'll see is, okay, our out-of-pocket price is $356. Right at the moment, don't pay attention to where it says maximum loss, $34,000. That's inconsequential at the moment. And we'll leave the stop at 5,000 because, well, on a call with only 10 days of analysis, the chances of us losing 5,000, well, we can't lose any more than 356, actually. All right, let me conclude the analysis, or at least what I'm trying to get across to you, by suggesting that, see, we're looking at, all right, what is the chances of us making money on this long call, which has an expiration of 30 days from now, but we are only interested in the next 10 days. Repeat, the next 10 days. So that's what we set up here. So I'm going to show you a couple of different scenarios and you'll see what I mean. So we valued the call at 356, and we're only going to stay in this trade for 10 days. Our information or our analysis suggests that, wow, we think this thing's going to pop within 10 days or it's not popping at all. In other words, after the 11th day, we're thinking we're going to get out of this trade. So based upon the input we've given, what we'd like to do is run crystal ball a couple of thousand times, which is right here, and see what are the odds. So let's run crystal ball right now and take a look at the probabilities that we may break even on this trade, again, based upon the assumptions that we've put in. So crystal ball right now, we'll go very quickly through 2,000 iterations. And you'll notice here on the net with stop, which this is what I really look for. Crystal ball from 0 break even to infinity is telling us that we've got about a 31% chance of finishing in the money. A 31% chance of finishing in the money. That's what's ever colored in a dark blue. And then in the salmon color, that's your distribution, which shows you losing money anywhere from 0 down to about negative 400. Now, when you look up at the statistics, you'll see the mean is an expected gain of negative 35, meaning that over the long haul, even though you might be right, on the one try, over the long haul, this same trade would lose you an average of $35 over 2,000 trials. So you're going to have to make up your own mind if it's worth the bet, the trade. Now let's get rid of this stop function. We'll be looking at that a little bit later, and let's look at where the stock would have traded over that 10-day period. So this distribution, and I'll make it a little larger here for us, this is showing us that starting at 170, we would expect this stock over the next 10 days to trade on the way on the low side, down here at the 3 standard deviation mark, to a low of 160.40, and up at the high side up to about 180, 179.69. So anywhere between 160 and 180 over the next 10 days. And this green line that you can see right here is an imposition of an actual normal distribution. So you can actually see the normal distribution and then the typical leptokurtic curve, which is going to occur when you mix up a log normal distribution and also with some volatility on the expected mean. In other words, the expected mean actual volatility. See, we've got it historical volatility at 10.5, and we've got the volatility of that volatility at 5, about 50%. So what we're suggesting is that the volatility will average 10%, but will vary anywhere by up to 15% or down to 5% on any given trial. So we've got a lot of volatility that's built into the model. So this was over 10 days. This is what we would expect. So, okay, keep in mind, if you will, these numbers. So 160 to 180, okay? And then also the idea we would have a 31% chance of winning the trade and expected gain of $35 loss. Expected gain of a negative 35. Now I'm going to reset Crystal Ball by clicking on the reset button and stretch this all the way out to 29.9 days. So let's call that, in fact, just for the giggles, we'll go at 29.999, and I should have made it 299.999. So almost, I want to get it so you can see what I'm exactly talking about, if I can ever type it correctly. Yep, still doesn't want to round that close. So tell you what, we'll just stick at 29 point. Why don't we just leave it at 29.9 and be done with it? You big dummy. Tell you what, maybe if I just click it down like so. There we go, finally. What I'm trying to show you here is that, all right, now we're planning on trading this call that we're going to buy for $3.56 on a 30-day option, but we're going to let it run all the way to within 1/10 of a day of expiration. So, you know, there's maybe an hour left to go into trade or something. That's whatever 1/10 of a trading day. It's about trading day is 6.5 hours, so you're looking at about 30 minutes. So with a half hour left to go in this trade, what we're doing is saying, all right, this is what the stock would do over the full duration if we let this puppy run out. That's exactly what we're doing. So we've left the days to expiry at 30, and we're setting the days of analysis all the way out to, with just a little tiny bit left in the trade, and we want to see what will it look like then. So let's run Crystal Ball, click the start button, let it run through its analysis. It'll give us a whole set of distributions again. And as soon as it's done, now this is doing 2,000 iterations. I'm going to shut off the stop feature. We don't need that. We can get rid of this now. And now you can see, I think, what I mean. Over the much longer period, what Crystal Ball is telling you is that, all right, we're still going to be centered around the 170. But instead of going from 160 to 180, obviously it's going to spread way out, in this case, to 153 at the 3 SD mark, SD meaning standard deviation, all the way up to about 187 on the 3 SD. So the mere fact that we extended the trade another 20 days is giving this asset a lot more time to wander away from the mean, which makes intuitive sense and, of course, is perfectly observed by empirical movement. Usually a stock has pretty quick pretty close reversion to mean tendencies the shorter you go. Obviously, if you only analyze a stock for 10 minutes or a 10-minute tick bar on a chart, it's going to move, but generally not too much. It's not going to move from 170 to 180 in 2 minutes. Not usually. But over a 30-day period, if you recall on the 20-day or the 10-day analysis, it only went from 160 to 180. Here it's going from 153 all the way up to 187. So now if we look at the call, you'll notice that what's happened is our probability of winning on a trade has dropped dramatically, all the way from 31% to about 20%, 19 and a half, which is right where I've got the cursor. So you're going to need to, is this worth the trade? You'll also notice that your maximum gain has increased on the very unlikely side. You could gain as much as it looks like about $900 on this trade. Well, that's because of the longer time you've stayed in the trade. But you'll also notice that instead of not losing the maximum amount, we've got about a 43% chance of losing all of our money, which was the $356. It was $356 for 1 times 100 contracts, or 100. One option controls 100 contracts, so a 356 price would cost you 356 to get in. So the expected average gain has gone from a negative 31 to a negative 149. So that's a quick review and gives you at least an understanding of how the spreadsheet works insofar as stretching out days to analysis. And I wanted to get that clear to you right away. Now, session 2, I'm going to close out. I'm going to reset the trade, or crystal ball rather, and reset this all to 5 days each. In this trade, what I'm looking at is going in on a Monday morning with a weekly and letting it expire on Friday afternoon. So clearly that'll be 5 days. And I wanted to explain the net sheet, which was net tab 1. So I'm going to set up a small spread on the put side, a bull put spread on the put side, and we'll go in and say 165 on going long the call. On the put side, we'll go in at 166. We'll come back and address the prices. On tab option 3, which is the short call, we'll go in at, let me get this recentered for you so you can see what I'm trying to discuss. We'll go in at 174, just to kind of make it even, and we'll go in with the long call at 175. Now let's say here you'll see at the implied volatility, the long call would cost us 15 cents. And let's say we could get a nickel for this. So we'll change the implied volatility down to where this equals 20. So 15, we're buying for 15, we're selling for 20. And then on the put side, showing a put buy price of 13. Let's say we could get it's showing 13. Let's bring this down to 20 cents. So it's showing 7 on the put. What we have here is an iron condor. We've got a long put at a strike of 165. We've got a short put at a strike of 166. We've got a short call at a strike of 174. And we've got a long call at 175. We're selling a credit spread, and for those of you, you can let me know. I'm going to also be putting up introductory classes soon. So I'm assuming, unfortunately, that you have, or fortunately, you have experience in numerous option trades. I'm just showing you in this session of series, I'm showing you how to trade the options that are mentioned in the book, the vertical options spread, which ironically is down here is a little logo in the far low right-hand corner. Let's look at the net sheet. And to do that, what we're going to do is now click open all 4 of the trades, the long put, the long call, the short put, and the short call. And you'll see what it's telling you is that, all right, you're going to get a credit with you're only trading one contract. Your maximum credit is $13. Your maximum gain is $13. 1-3. Your maximum loss potential, of course, is the difference between the 2 strike prices minus it's actually the difference between what the credit is, the 13 cents, and the 1 contract. So your maximum loss is $87. If this trade winds up going below 165 or above 175 in the next 5 days, What it's telling you is that you're going to lose all $87 unless you shut the trade down. Interestingly, I put in these little spinners here, and this one at the very top, the big one, allows you to look just to your right where it says net with stop and just click one at a time so you could see what the trade might look like one at a time. This is what Crystal Ball is doing 2,000 times in a row or 5,000 times, whatever makes you feel comfortable. The larger the sample size, theoretically, the more precision in the estimate. So one at a time. Now, let me explain this trade. And I'm explaining this chart right here. This down here, where I've got Monday, Tuesday, Wednesday, Thursday, the Monday here represents all the way till Tuesday, effectively what the trade looks like over the whole 24 hours. Then Tuesday to Wednesday, and Wednesday to Thursday, and then here's the start of Friday, and then of course this would be Friday at about 4 o'clock New York time. So this trade, when you look at it, this trade never caused you any problems, which is unusual. It just basically climbed this ladder and had a few bounces around, but then finally, as you got to Friday, the asset was, say, at 170, and what happened was that you got the full credit of $13. In fact, this is just the final part of the theta bleed off. The time a decay. That's all it represents. So if we click it a few times, I'm trying to get an example where you're showing a lot of volatility. Well, this is a pretty good example. On this crystal ball example, this one's showing you losing money, and in this case, it only goes down because you only got one contract, $10. And now around Tuesday, the stock starts to come back to the reversion to mean, and then Wednesday through Friday, it comes back in and you still win. So this is a high probability trade. I mean, no, that's a good one. I like that's a lot of volatility, and I've had trades that look like this. So on this trade, it started working out well. Then the asset got very volatile, and you're losing quite a bit of money. Then it comes back up. Then it goes back down, and then finally you wind up gaining $1 on the trade. Kind of not worth it, and it's scary looking. Let's see if we can get a loser in here. It'll be unusual because of the probabilities running in your favor. So I'm just clicking through a whole bunch of. There we go. Finally, there's a loser. So on this trade, you put it down on Monday. It kind of hugged around at basically making nothing, a couple of bucks here or there. And then finally, the asset started to get very, very volatile and then drops all the way until finally you lose almost your full $87. Not quite, but that was a bad trade. That was a bad week for you. So if we look down here at the very bottom, I'm going to scroll all the way down. And what happened with this was that, in theory, the stock price, in fact, we have to go to tab option 1. Let's see what happened with this stock price. At the very end of the analysis, see the stock traded at 175.39 on this trial, which is why you lost virtually all your money on this trade, because the stock went from 170 and went all the way up to 139, which means that you wound up losing. You can see the $82 loss here. So these columns are simply valuing the options, the spread as we went along. All right, let's look at this. Let me explain at the net sheet. What this is telling you is long put, short call, long call. The stop price I have set in here, but I've got it set in here at $5,000, which only would apply to trades where you're, and you can click on this button to change the stop loss figure. I usually use 100 contracts, which will give me the 5,000 stop loss usually represents about 50% on 100,000. Right now we're just trading one option. Here you're showing the price. You're buying for 13, you're selling for 20. With the short call, you're selling for 20 and buying the cover stock for 15. So that gives you your hedge. And then I'm extending the quantity out, so 13 cents times 100. Each contract represents 100 shares, so that's $13 buy, $20 sell, $20 sell, $15 buy. So you've got 40 less round numbers, 28. So you've got a $13 credit spread. And I put in commission here just to give you an idea of what would happen how much would you pay on this trade? So in this case, it'd be about $25. 4 times 6 rounded, and some rounding error here. I apologize for that. And then what's happening is that the options are being valued, and finally the price is being netted out, and it's doing. Crystal Ball is taking all of these numbers, this large array of numbers, and then running the analysis 2,000 times or whatever you set it for. Let's set it up for 3,000 right there. In the box you can see where I just changed the figure to 3,000. So we run this trade on Crystal Ball, and after a few moments we'll get the stock movement during the course of the week based upon the data we put in. So it's run at 3,000 times. That's amazing. Let's shut off that stop price. So what Crystal Ball is telling us is the prediction that this stock will trade anywhere between 163 up to 177. But if you look at each one of these vertical blue lines, the 1 and 2 on either side, you're looking at the standard deviation points. So you can kind of get an idea of where this thing should wind up being. On the net, with no stop, and I'll make this a little larger so that we can all see it, the chances of breaking even, making $0 to $13 on this trade, is about 91.6%. So you've got a high probability trade here. The mean payoff of it is about $7. You're not going to make, according to the distribution, you're not going to make $13, the full payoff, all the time. So eventually you're going to lose. In fact, we can even go and extract the data. I'll show you what I mean by that. If we extract the data and we want to look at all the trial values, Crystal Ball will actually tell us, all right, here's all 3,000 trials. So I'm just going to scroll down here so you can kind of get an idea of the magnitude of the analysis that I'm discussing. I'm scrolling down and I'm going to stop at, say, 1,500. It'll continue, but this is just showing you that, so here's, for example, is trade 1,500, which happens to be a winner. And it's also showing you the end of period stock price on that iteration, which was 168.34. Anywhere between 166 on our trade and 174, that was the spread we had set up, this trade would make us $13. On this one, on trade number 1539 right here, you'll notice we lost $86. Well, that's because the asset traded down on that iteration to 175.69. So you can also see very easily the distribution of the payoffs. So here we lost the full 87. So out of $100, we lost 87%. Here we gained 13%. And on this one, in trade 1513, we lost only $16, and that's because, take a look at that. We had a short call, or put rather, at 166. So it ate into the trade 165.79. In theory, what would happen is you wouldn't lose all your money. You'd close that trade out, and you would only lose a small portion of the credit. You'd have to buy it back for 16 plus the 13, or about $29 at close. So this is an enormous, oh, here's one, look at this, 2 losses in a row. So if this represented weeks, this gives you a good idea of, all right, what would actually my trading look like? And as I pointed out in the book, let me just go right back home. On the very first week, you lost. Interesting. The stock on the iteration or the trial went all the way down to 162.81. You lost all your money, and you probably wanted to sell the book, burn the book, curse me or sue me or whatever. But if you look then with the fact of the high probability trading, then you go 22 weeks in a row and you win. So an $87 loss takes approximately 7 weeks to win back your money, and you've done more than that. So the main key with the net sheet is that it allows you to take, after we've put the inputs in, on tab options 1, 2, 3, and 4, the net sheet is what allows you to say, all right, what is this going to look like over time? And then run your crystal ball simulations and set up the pattern. And as I said, I've made these as toggles so you can switch them off. Like if you wanted to look just at a long call, you'd switch everything off except the long call. Or let's say you wanted to look at just a long put. Well, then you could obviously switch everything off except the long put. If you're looking at an iron condor, you switch everything on like we did for this small $13 trade. So summarizing in this lesson 2, trading spread, this is the trading spreadsheet that you have access to. Tab option 1 is, I'm making this giant, and now I'm making it too small. Bear with me, I'll get back to the top here in a second. It's a little difficult to control because I can't see the cursor real well. On tab option 1, you're looking at your long put and your basic setup area for putting in your annual return estimate, your historical volatility, the price of the stock, your days of expiry, and your days to expiry, and your days of analysis. So you could put in a 90-day days to expiry and then only analyze 20 or 30 or 40 days, whatever you decide to do. On tab option 2, you're looking at your short put, and the only thing you need to control is your strike price and the implied volatility, which controls the market price of the short put. Tab option 3 is the short call for the iron condor, where you only again control the implied volatility, the strike price, and the short call price. And tab option 4 is the long call, where you can control your strike price, the implied volatility, and then the long call price by adjusting the implied volatility. Then come back to your net sheet to actually look at, okay, what is everything I've done on the first 4 sheets look like? And then I'll run my crystal ball analysis. And then to close this section up, also what you're going to want to do is to do some simulation and scenario analysis. In other words, come back to tab option 1 and change this up a bit. What's it going to look like at different historical volatilities? Or what's it going to look like if the annual stock return is supposed to go up at a rate of 10% annually or down? You can use, this is a very flexible sheet, and I intend to make it even more flexible. I have some ideas on that already, but right now we're just getting used to it, and I'm past my 30-minute duration. So this is introduction and learning to use the trading spreadsheet. My name is Charles Conrick. Happy to have you aboard, and I look forward to getting more involved with you in the future. We'll be back with trading options sheet 3 on the next lesson. And I'm also going to want to show you what I call the amazing spreadsheet. So we might take a break from this. But nevertheless, we're going to be covering a lot of material in this. So thanks a lot for watching, and we'll be back for the next lesson.